Now that we're a little bit more than midway through first quarter earnings season, Sam Stovall from S&P Capital IQ is here to give us his view of the results so far. Welcome, Sam, and tell me, what is the biggest takeaway so far?
Hey, Greg. Well, I think the biggest takeaway so far is that management's ability to manage expectations is alive and well. Basically, the expectation was we would only see about 0.5% increase in year-over-year operating earnings results for this first quarter, but now it looks as if we're going to get something closer to 3.7% growth. So management of expectations is still very much alive.
And we've seen a lot of top line misses, but bottom line beats. So what does this say about demand in the economy?
I think what it says is that demand is still fairly tepid. Early in the reporting period, S&P Capital IQ thought we would see about 4% growth in revenues. Now the expectation is for less than half that, and I think that really most of the earnings growth has been coming from cost cutting as well as share repurchase programs. So it would imply to me that we're probably not going to be seeing the unemployment rate drop precipitously anytime soon, and that corporate management are still going to be keeping their hands very tightly clasped onto their purse strings and to keep a lot of their cash on hand.
And in your view, which sector has shown the greatest number of positive surprises?
Well, I was scanning along the 10 sectors out there, and a lot of them were showing improved earnings expectations as compared with what we were looking for in early April. I would also tend to say that the largest advance is likely to be seen in the telecom space, mainly because of improvements in wireless and the ability for these companies to convert a lot of the users of the smartphones into more expensive programs.
All right, what about in terms of downside surprises? Which sector disappointed investors the most?
I would tend to say that that's technology, even though their loss is expected to be lighter than what was anticipated earlier in the month. The belief still is that these larger blue chip stocks that used to be regarded as sterling are now regarded as being tarnished. So I would tend to say that the technology companies are the ones that have been disappointing both on earnings as well as on the revenue side.
Considering stocks run up in the first quarter and the lack of top line beats, do you think stocks got ahead of the economy in the first quarter?
It seems as if they might have. Usually what we find is that good momentum in the beginning of the year tends to carry out for the remainder of the year, but I wouldn't assume that the digestion of gains has been repealed. So I would tend to say that we probably will see some period in which the market does go through at least a correction in time, but probably more likely to see some sort of correction in terms of price. But it'll probably happen a little bit later than most people are anticipating. Rather than selling in the beginning of May, maybe we end up selling toward the latter part of May or even into June.
All right, thanks a lot, Sam Stovall.